Today we are at Texel Finance London, and I welcome Carol Seal, General Counsel, and Simon Besant, Global Head of Credit Insurance. I'm delighted to be taking you today about credit insurance in the financial sector. Carol, what significance does a non-payment insurance have for the financial sector?
So I think there's a large volume of bank lending that is supported by non-payment or credit insurance. And we see this particularly in some recent industry surveys that have been conducted by ITFA and the IACPM. So in 2021 survey indicated $346 billion of lending in 2020 was supported by non-payment insurance. That survey has recently been updated, and I understand when it's published we will see this was increased to 400 billion as of 2022, and that's just 1 year's worth of lending. So it's a very significant part of bank lending.
Very good. So which products in the financial sector are relevant, Simon, for non-payment insurance?
I mean, I think to talk to Carol's point just there, it's probably worth initially focusing on real economic drivers and how insurance can support the global trade flows, north to north, south to south, south to north. I think it's very much an enabler of trade, and hence, if you look at the insurance market's impact on trade finance products, you can see a significant portion of the insurance product is used to support such trade finance innovations. It very regularly is used in scale in supply chain finance and working capital finance, in letters of credit to support issuing bank and confirmations of import and export LCs. And so you look at insurance and its value in that space is a significant enabler of global trade flows. Of course, if you look at the non-payment insurance product more broadly, it can support any form of credit exposure that is documented in a clear and accessible fashion and is explainable to an insurer, right through from the loan products to the derivative products. But I think the core of the insurance market has always been to support trade, and to use it for an IACPM stats, that it's many, many hundreds of billions of trade that is facilitated using insurance. So I think it's definitely an insurance product that can be used right across the spectrum of lending and guarantee tools. But certainly the core remains trade. And I think that's where the sort of significant global economic value can be seen from trade credit and non-payment insurance.
Yeah, so what is the value of non-payment insurance for the financial sector, thinking about capital relief and all the topics related to that?
I think, again, if you look at value, you probably have to step back and consider why somebody is buying the insurance or why an institution is buying insurance. Obviously, they can ascribe certain values to products that maybe are not always the classical, simple non-payment insurance is great for capital relief. Of course, that is one of the core drivers of the product, but it is not the reason that every financial institution uses non-payment insurance. If we look at it simplistically in that way, balance sheet management, capital optimization, credit substitution using insurance and taking the risk of your counterparty and swapping it with the risk of a better rated guarantor should, in theory, reduce the capital that you can allocate to the insured piece of any transaction. That is obviously very helpful for banks who are looking to manage the capital that they have allocated to their product lines and optimize the balance sheet, originate, distribute in an efficient way. But it's only one reason I would suggest that non-payment is used. And actually, maybe more regularly, non-payment is often utilized as a form of limit management. Banks like to lend and support their clients, and they can therefore obtain quite sizable single risk exposures within their portfolios. And non-payment insurance is used to mitigate those and to allow them to do more with their clients. I think we talk about capital optimization and balance sheet management, and of course it's a critical part of the product and the value of the product. But I think we shouldn't forget some of the other benefits of it. And I think actually, from the insurance market's perspective, understanding a client and supporting them to do more with their client base and release credit limit is a real incentive for an insurer to support a bank. So I think that's something that we shouldn't forget. And I think it is also a significant value add from the insurance product. It can also be used, and I would assume is valued by banks in that fashion, because it can allow you to increase your commitment in a loan, for example, or increase your commitment into a supply chain financing structure without advising or giving any form of notice to the borrower that you're doing anything other than increasing your willingness to participate with them. It's a silent product. It sits behind you. It facilitates increases in banks lending, but in a fashion which is, I would suggest, positive for a financial institution who doesn't have to explain why it is able to increase it. It is a silent tool, and therefore, that form of increased ability by deal is certainly relevant. Generally, if you increase your commitment into a transaction, that would normally allow a larger share of fees by banks in increasing their role within individual transactions. So in theory, the insurance product can increase front-end fees. It can allow you to commit more to transactions. And I would suggest, in theory, there should also be some margin or income skim. The cost of your insurance protection economically should not be detrimental to the buyer of the insurance. In fact, it should be additive. One would assume that if you're swapping the counterparty risk into a well-rated insurance company, you now face that insurance company. Your cost of facing that insurance company should be much reduced, and therefore you should be able to skim out of the differential between the insurance premium and the income you receive from the loan or the underlying financial product. And I think the final sort of value add is maybe more subjective. It's often that within an institution, you have people who are sometimes concerned about new geographies, about new clients, about operating in maybe a new environment, and a third party that's not related to your institution who validates that this is a good transaction, is willing to take credit risk into that transaction, I think provides I guess an objective, but also potentially more of a subjective confidence to individuals, to risk teams, to origination bankers, that actually it is a good transaction. It's a validation that what you're doing is also treated as an acceptable risk by a third party who has looked at it independently and formed a judgment on that transaction. So I think there's that, and that's you can't really sort of put a value to that. It allows banks to do new transactions or to enter new geographies with support from a silent risk partner. And it can be utilized to show risk teams that there are other parties who believe this is a good risk. So I think there's plenty of value and plenty of reasons to use it. And often our clients are taking that value across many different benefits and on their balance sheet and also throughout their P&L.
Yeah. Carol, so coming to the next point, what is the relevance of the evolution of banking regulation on the use of non-payment insurance for the financial sector in Europe? And what major challenges had to be overcome in that?
So I think Simon has covered a bit of this quite neatly, and we're really looking at the convergence here of banking regulation and the insurance market, and particularly with Basel II in 2004, which introduced, I'd say, two key things. One was the introduction of allowing banks to use internal models to calculate their credit risk, was quite a significant feature. And the other important point was the introduction back then of the ability to use an eligible guarantee as a risk-weighted asset substitute for that of the borrower. And I think these are two quite important things where the insurance industry saw an opportunity, and using that regulation worked on product development to provide a product which is eligible as a guarantee for the purpose of providing capital relief to banks. And I know there are very many other reasons why banks will buy insurance, as Simon mentioned, but I think the value of this banking regulation meant that the drafting of the product was really tight and really clear in terms of the way it would respond to claims and losses, because it has to be an eligible product. So I think that really, I believe, is the driver behind the growth of the product, regardless of the fact it's used in so many other ways and maybe not by all banks to obtain some form of capital relief. The same survey I referred to earlier does indicate of the banks that participated in that survey, there was something like over 80% of them do use the product as one of their top 3 goals or reasons for using is to get capital relief. So it is still a very significant reason behind the buying of the product. As to the challenges, I think one of the things was, as Simon said as well, it's a bit of a silent product. It doesn't have a lot of press. What we do see in times of crisis is problems about trade credit insurance and cancelable limits, which isn't the same as a non-payment product being used as an eligible product for capital relief. So it gets sort of this bad press, but it's silent and not a lot of education out there to people who don't use it and aren't involved in it. So I think one of the challenges has been, in recent years, we've seen more regulatory grappling with it. We had the PRA consultation in 2018, where the PRA looked specifically at the eligibility criteria. What did you have to do to comply to have this product to be used in this way? And that was actually quite helpful in the end for the market. A lot of people responded to that. And the EBA has also provided some guidelines on different credit risk mitigation techniques. We had Basel III in 2014 when it was implemented in Europe, and this didn't really change the eligibility criteria or the economics of the benefits of using the product for capital relief. So I think where we are as a market under Basel III as it stands in Europe has been very good and very helpful, particularly for advanced banks who use an internal model when they're calculating risk-weighted assets.
What is the potential impact of Basel IV from your perspective on the use of banks and financial institutions of non-payment insurance? And maybe another idea is what is the industry hoping to achieve?
Basel IV is an interesting one just generally on banks. So it's a bit of a wait and see because its impact is going to be so variable. But certainly insofar as the insurance industry is concerned, the big issue is an economic question. It's not about eligibility, it's about the economics of the use of insurance. And here we're seeing likely a particular impact on advanced banks where most of the impact of Basel IV is going to be felt. And this is because one of the key features of Basel IV is to take away the variability in the calculation of credit risk and how capital is allocated. And here the regulators are now going to preset an LGD for financial institutions, and insurance companies have been clearly designated as financial institutions for this purpose. That means that when you are doing a risk weighting of assets for an insurer who's a guarantee provider, they will be allocated a 45% LGD, whereas before that would have been modeled to something different. So I think the insurance industry has been looking at this and grappling with this for quite a few years now. And we started a few years ago through ITFA, an industry body, to see what could be done to highlight in Europe to the European Commission, what insurance is really about and why it is important and why it should be considered separately and differently from a financial institution, particularly in a situation where a bank is a policy holder and is using insurance as a guarantee for capital relief, as opposed to a bank lending to an insurance company. And because banks have, as a policy holder, a senior status, the feeling is very much that it's really not appropriate to have a 45% LGD. So the industry's been working very hard on this particular issue, and I think this is one of the key drivers for all these surveys that have recently been conducted to try and gather data to support the case. We had some success last year when the European Commission published its draft proposals for the implementation of Basel IV, and there is recognition that has been given that there could be potentially a special case for insurance, but they want data. So the EBA is going to be commissioned to consider the case for insurance along with EIOPA, the insurance regulator in Europe, and they are due to report back to the European Commission, and then we will have to see what happens. So in terms of challenges, we are waiting to see what the final outcome of this text will be, and I think this is imminent sometime in the next few weeks. The key issue at the moment is what the timing of that will be, and whether that will coincide with or come at a later time for the overall implementation of Basel IV. So it's a bit of a wait and see at the moment. Yeah.
Right. Simon, what role can your company play in providing support to banks and financial institutions for risk mitigation and especially non-payment insurance in particular?
Our role as an intermediary, I think, is something that sort of education piece is part of the role of an intermediary in any form of financial transaction. Our job here is often to guide and support new entrants willing to utilize the product and provide them with guidance as to policy drafting, documentation, best ways to approach insurers, relationship management, all of these things. But I would suggest we're part of a community, and coming to one party and saying, support me to do this is obviously, to our benefit. But actually, I would suggest there is a lot more transparent information now. There's a lot more data and product knowledge that sits around insurers, insurance brokers, associations, third parties who provide, data and rating agency reviews, such that we're one of a part of that community. So we wouldn't possibly expect to say, our role is just to take somebody, a new financial institution, take them from start to finish, and they don't need anybody else. Of course, we can support them in that process. And I think, we're incredibly good at that, but it would be relevant, I think, for them also to speak to insurers, to understand the wide variety of participants in this financial ecosystem, of which we're just one part of it. But to that effect, our insurance market would like and continues to need new financial institution clients. So people should explore and consider how to utilize the product as efficiently and effectively as they can. But this is still a product which is based on relationships. And I think one of the difficult or the push and pulls in non-payment insurance is between standardization and bespoke nature of the documentation. And I think it's important to reflect on the fact that our market is still a relationship-focused market, and hence it's recognizes that it wants to and chooses to work with counterparties based on their confidence and their comfort working with each other. And so people, when they come to use the insurance product, they should recognize that there's probably a fair bit of transparency and due diligence required to ensure that they can get the best of the insurance market and its capacity to take on risk. And we can advise on that process. But at the end of the day, they are the contractual party entering into it with the insurer. So both sides need to be confident in each other, and we're there hopefully to bring them together and allow them to better understand how they should manage their policy, what their policy should look like, and ensure that the claims get paid. But really, it is something whereby that direct discussion sometimes between clients and insurers we think is vital and helps build trust.
Simon, thank you very much.
No worries, thank you.
Thank you.